It's been a string of poor news for the UK today as the economy witnessed the triple threat of GDP, current account and news of capital shortfall. David Tinsley, Chief UK Economist at BNP Paribas, is on the phone with me now. David, which of today's news items should we be most concerned about?
Well, in a more medium-term sense, it's probably the news on UK banks' capital shortfall that is most pertinent to getting a UK recovery going over the next few years. The GDP figures that came out today were old news, essentially, the third estimate of the fourth quarter figures. And the current account figures are noteworthy in that there's a large current account deficit as a percentage of GDP. But really, one of the secrets to getting that smaller is by getting credit moving in the economy, and that then takes us back to worrying about the UK bank's position.
Starting with today's current account data, Britain's current account deficit was reported at its highest level since 1989 today, reaching £57.7 billion, 3.7% of gross domestic product in 2012. What can we attribute this increase to?
Well, there's a couple of things that the widening in the current account is due to. Most obviously, service sector exports last year were weak, and in part that reflects, again, the performance of financial services exports. Alongside that, the income balance in the UK current account has slipped quite a long way as well, mainly reflecting the earnings of UK-owned companies overseas. Of course, that's probably in part reflecting the weakness of the Eurozone economy. So there's a number of factors in play, not all of which are likely to be reversed very soon.
The Bank of England has today told UK lenders that it must raise at least £25 billion to plug a shortflow in capital by issuing new capital or restructuring balance sheets in a way that does not hinder lending to the economy. What options do UK banks have open to them to meet this shortfall?
Well, we know that one of the options the banks don't have is to get public sector infusions of cash, at least for the foreseeable future. The UK government's been quite clear it doesn't have the appetite, partly for political reasons, to inject new public money into the banks, and that's not likely to change over the next couple of years or so. In terms of other options to address that capital shortfall, there are essentially two. There's deleveraging, in other words, a continued period of restricted credit growth in the UK, and that's not a desirable outcome. Or there's some kind of restructuring of non-core assets in the banks. Some of them still own quite substantial foreign assets that they could sell, and that's probably preferable. But again, the risk is, I guess, that addressing the situation in those terms rather than via public sector recapitalisation means that the whole process will take some time.
UK stocks were mostly lower on this Wednesday as reports confirmed a 0.3% contraction in GDP. While this statistic was largely anticipated, as you've mentioned, is the outlook brighter for the first quarter of 2013, or is continuing poor weather likely to weigh further on growth?
Well, the outlook might be a little bit better, but largely in an underlying sense. There's the surveys of service sector and manufacturing activity are a little bit firmer than perhaps the 0.3 contraction in GDP would suggest, but clearly the weather is a factor in this quarter. We had a cold spell at the end of January, beginning of February, and then it's really returned with a vengeance in March. So when we had a similar cold snap in 2009, the ONS were estimating at the time that it knocked about 0.5 of GDP in the fourth quarter. Now, it's probably the level of disruption probably hasn't been as great as that, because that was quite a lot of lying snow. But nonetheless, it certainly could mean the difference between contraction or expansion in the UK in Q1.
David Tinsley of BNP Paribas there, speaking with me from London. I'll be back tomorrow with our latest edition of Commodities Corner. Until then, goodbye.